When I started investing, I would run a very concentrated portfolio. I would put in one or two stocks. And my thinking was that I'm going to pick one stock and it's going to go up, and then I'm going to sell it, and then I'll repeat. So I'll be rich. I'll be rich. Very quickly, I discovered that this is extremely risky. Not only that it's going to tie up my money for a very long time if the stock doesn't perform, I can even lose all the money. So this doesn't work. So I realized that I need to study from the best. Warren Buffett is arguably the best investor ever lived in history. And so I started to study Warren Buffett. And Warren Buffett has two rules for investing. Rule number one, don't lose money. Rule number two, don't forget rule number one. Rule number three, don't forget rule number 1 and 2. I made that up. So if you think about it, how can you not lose money? Of course, Warren Buffett doesn't mean buy a stock and the stock must only go up. What he is saying is that risk is the possibility of losing capital permanently. So what he is saying is that it's okay to have up and down in stocks, but it's not okay that you buy into some company you don't really understand and then you lose your capital permanently. So I would basically look into Warren Buffett's portfolio and see what kind of stocks he's holding. And whenever there's a market downturn, I would select stocks that I think which is undervalued. I'll buy the stock. So basically, my investment universe is Warren Buffett's portfolio. So I've been studying Warren Buffett for a number of years, and I think his investment can boil down to three things. Number one, always pay attention to downside and have a margin of safety. Number two, stay within your circle of competence. Number three, bet only when the odds are favorable. So these three principles I've been following ever since, and till this day, I think it changed how I invest permanently. So Warren Buffett becomes my personal hero. But so I did that for a while. Then I realized there's problems as well. And first of all, Warren Buffett also makes mistakes. I think a couple of years ago, he bought into IBM and then later on sold at a loss. And also, Buffett liked boring, simple business. But we're living in an age that the technology industry is growing extremely fast. And there's technology coming into the market every year. And they're wonderful businesses. They're taking market share from traditional competitors. By basically investing in Warren Buffett's portfolio, I'm missing a lot of growth opportunities. So I decided I need to expand my investment universe. So I need to learn more companies as quickly as I can. So I would go into different companies and just randomly pick companies from S&P 500. Whenever I heard something from the news media, I'll just check their annual reports and just try to learn the business and understand their financials. So I did that for a very long time. But after a while, I found first of all, I forget all the companies very quickly because there are so many companies. There are a couple hundred companies in S&P 500. I just can't remember all the research I have done. And secondly, no matter how hard I look into the company, I don't feel comfortable buying into these companies for some reason or not. I always feel like these companies are not within my circle of competence and they're too risky and I don't know what's going on. So I studied a lot of companies, but I never bought anything. And then I reflected on the question, how do I learn? How do I learn? So really for me, I learn from experiences. I learn the most from my mistakes. So I decided to step out my circle of competence, just to buy into a few companies I think have great potential. It turned out this strategy works really well for me. And I would allocate 5 to 10% of my capital into this experimental portfolio. What I found was that once I own the company, I can understand the company's business much better than just put the company in the paper portfolio because I don't follow the company as closely as the companies that I'm holding. And also I discovered that there's a lot of companies, it grows really fast, it's extremely volatile. So the stock can go down 30-40% if the company is missing one earning. In that way, I learned about myself. I learned about how I would react to different market conditions. In a way, I learned the company better, and I learned myself better. I understand myself better. So I can find a strategy that is best suitable for me. And sometimes it turns out that if I buy 10 companies, maybe 5 or 6 or even 7 don't work out at all. But occasionally there are 2 or 3 companies. They grow really, really fast, and the profit I made from these companies is way more than the amount I can make up the losses from the other 6 or 7 companies. So I think for me, the easiest and quickest way to learn about a company is to invest first and investigate later. This almost sounds like a contradictory. According to Warren Buffett, my hero, you should always stay within a circle of competence. But I think the important thing is also that you need to expand your circle of competence. And how are you going to expand? So you have to occasionally step out of your comfort zone and invest into those new companies, new industries, and learn from those companies. We are living in the age of rapid change, and it changes faster and faster. I think more than ever, there are better investment opportunities exist in the market. And there are new technologies and new industries and new companies changing our lives. Just look around. And also, there is a famous problem in artificial intelligence called exploration versus exploitation. Basically, the idea is that to make good decisions, you need to actually explore a little bit. So if you only exploit, meaning that if you only make decisions within a certain area that you are familiar with, you will get stuck in the local optima. But what you want to do is you want to have a global optima. So the best return can be achieved by allocating a portion of your portfolio, maybe 5 to 10%, into exploration, to explore different companies. And when you do the exploration, just hold on to it for a few months. So in these few months, pay attention to the stock behavior and pay attention to the management and study the financial reports and understand yourself. See, how do you feel holding the company? If you are comfortable holding a very volatile company, and learn about yourself. So now I run a 3-tier strategy. First of all, I have an investment universe. It consists of several hundred companies that I have researched before. I'm sort of familiar with them. And then in the portfolio, in my actual portfolio, I actually have an experimental portion, about 5 to 10% of my capital. And the other 90% to 95%, I only invest in the company I'm extremely confident. So in summary, the best way to learn about a company, of course, is to study as much as you can, to read the financial reports and learn about business models. But if you want to really understand the behavior of a stock and how you're going to react to the behavior, you need to actually own it. And just be mindful that when you actually run the experiments, use very small amount of capital. How small, it depends on your personal situation. For me, I use 5 to 10% because even if I lose 40, 50% of my investment, I'm still okay with it. When you pick the companies for the experimental portfolio, make sure that you hold the company for at least a few months. So that way you can learn more about the business model, the management, and can you tolerate the volatility, and learn about your emotions when the stock goes up and down. So if you like this video, please subscribe, give us a thumbs up, and I'll see you in future videos.